Okay.
Yeah.
Hello, everyone. My name is Faina Schneiderman. I'm an event manager and event organizer, and we are together with Ivan Petrikov. I'm sorry. We're together with Ivan Pestrikov and Business Community Speculant are organizing online business conference to show people how to benefit from current situation. Thank you so much for joining us. And we are really ready for to get interesting information. Let me introduce you to our friend Daniel Rezhets. He is financial advisor in Empire Asset Management. Daniel?
Hi. Hello, everyone.
Yeah, hi.
Let me say a few words. My name is Daniel Rezhets, and first and foremost, I would like to send all the participants, thank you so much for taking time out of your busy schedules. Not that we have a lot of other things to do right now, but nevertheless, it's very much appreciated, and we are delighted that you're here with us tonight. I would like to say a few words, and I will introduce my colleagues and the speakers in a minute. The purpose of the meeting is just basic to give an overview on the current situations, what's going on in the economic world, in the financial world. Everyone needs guidance. There are numerous people that currently invested in the financial markets and are very concerned about what's been going on in the past couple of weeks. There are numerous people that are not invested in the market yet and wondering, if it's a time to use the opportunity. So without further ado, I would like to introduce the CEO of Empire Asset Management. That's the company who I work for as a financial advisor. I would like to introduce Mr. Greg Zioli, who would be our first speaker tonight. And after Greg will say a few words, we would have our main speaker, Mr. Antony Manory, who is our Chief Financial Officer at the firm, and he will share, his views and his guidance about the current situation. Greg.
Thank you, Daniel. Hello, everyone. I'm Greg Zioli. I'm the CEO of Empire Asset Management, and I want to thank you for giving us an opportunity to participate in your financial discussions. Wherever you are dialing in from, I hope you and your family are safe with the current events, and we wish you well. But tonight, we're going to talk a little bit about investing and what that means. We're not going to speak about individual companies or trading, but rather a philosophy that, if applied, will be the basis of a more predictable financial future. I know many are saying what we're seeing today is unprecedented, and I would agree with that. But the effects it's having on the market is not. We've seen these types of declines many times before, caused by all types of things that also appear to be unprecedented in the moment. Wars, financial crises, oil embargoes, cybersecurities, flash crash. But each time the result was the same, and the market ultimately moved higher. We've seen that from history. It'll continue to go that way. We like to teach financial literacy. So when those times come, and they will, I promise, this time and another time, you're going to be more prepared to navigate through those uncertainties. So we're obviously not going to be able to accomplish all of that tonight, but we hope, after Tony's done speaking, that we're going to provoke some questions that you may have, that hopefully we can answer for them in the future, and help educate and give you a better financial literacy to discuss what your portfolio could look like, whether it's today, this crisis, the next crisis, and to give you a degree of comfort that you're managing the appropriate way. Before I hand it over to Tony, like to talk about a recent statistic that's been in the news because we're getting a lot of calls similar to the thoughts and questions that you have, and I'm going to guess at some of the questions you should have. Should I invest in the market? Should I buy? Should I sell? Should I trade the market? So if you look back to the 1930s, the Great Depression, if you placed your money into the indexes back in the 30s and you did nothing but hold on to that money until today, your returns would be roughly 15,000%. If you tried to trade in and out of that market, buy and sell, to try to guess the market or be on one side, and you just missed 10 trading sessions over the last 80 years, your returns would only be 91%. 91% to 15,000. This philosophy that we're going to talk about isn't new. There's a small investor that you've probably heard about it. He lives by it. His name's Warren Buffett. We just try to educate people so they know about it. So with that, I'd like to introduce you to Tony Manory. He's our Chief Investment Officer, and he's going to take you through some of the more specifics about this, what we think about it, why it's really not much different from the effects that it's had, what the differences are, and hopefully give you a better understanding on how to navigate future crises. That's it. Thank you very much. Tony.
Thank you, Greg. Thanks, Daniel, as well. Welcome, everyone. I'm happy to speak with you tonight, and I do also appreciate your time. Just to give you a brief outline of what I'm going to try to accomplish here before we have some question and answer at the end. In this introductory phase, I'm going to step back a little bit before the current crisis and talk about the historical relationship between economies and markets. Now, logically, one would assume there's always a relationship between them, but they often diverge, and that's what makes investing so mentally challenging. After we talk about that introduction, I'm going to talk about some investing fundamentals. A few of them Greg already touched on. Then we'll get a little more specific of what we're calling the COVID-19 recession that we're probably in the midst of. And then I'll wrap it all up with a conclusion and, again, open it up for questions. Now, I just mentioned talking about the historical relationship between the economy and markets. And I'm never sure when I'm talking to a new group of people how much financial or economic background they might have. So I will pause as I'm going to maybe describe something a little in depth that I'm talking about. And there may be some basic things some of you know or all of you know. I don't mean any disrespect at all. I just want to make sure everyone's getting these foundational principles to have a better grasp of where I'm going with the conversation. In a normally functioning economy, which obviously we're not in one right now, you have cyclicality. You have periods of growth, you have periods of mediocrity, and then you have periods where the market takes a break, it recesses, you have a recession, you have negative growth. Now, usually that is caused by the cyclical natures of an economy. In other words, if activity is measured by something you may have heard in the news called GDP, gross domestic product. All GDP is, it's the adding up of everything that's going on in the economy. The bottle of water you buy at the corner, the restaurant you and your family go to, the car you buy, the people who sold it to you, they get income, they go spend their money, a big corporation issues bonds or stocks. All of this activity is our gross domestic product. And periodically, there's no automatic time frame like you hear some people say, because it's been so long before this that we've had a recession, well, we're due for one. Well, no, that's not true. Okay, something has to break. But in a normally functioning economy, that break is usually caused by what we call economic imbalances. Here's an example of one. There's many different ones. The economy's doing really great And in simplistic terms, it starts to overheat. So businesses and corporations, they're producing more and more inventory. And then suddenly the economy slows, and not only are their sales going to drop, but they have excess inventory. You get slack in the economy. Another way you end up in a recession is sometimes because the economy is getting a little too hot, a central bank, here the Federal Reserve, may raise our interest rates, and that chokes off growth. So all of a sudden, we recess. Now, whenever there's a recession, you can be certain that the stock market in that country, if not around the globe, has started to fall. It's an amazing phenomena. It's, for anyone who's studied any mathematics or statistics, it's sort of known as the wisdom of the crowds. One single person, Tony, may not be able to predict that we're going to have a recession 6 months from now, but millions and millions and even billions of investors and how they're placing their money and what they're buying and selling and what asset classes are moving, the stock market does a pretty good job of predicting something that's going to happen 6 months from now. Again, I'm talking about in a normally functioning economy. As we'll talk more about with this situation, we were literally sprinting along, and unfortunately we were running and we fell off a cliff. I'll come back to that in a moment. Now, that link between the economy and the markets, which makes perfect sense that it exists. Obviously, if an economy is growing, companies' earnings should grow. If companies' earnings are growing, in most situations, their stock prices are going to rise. But that relationship does not move in lockstep. And the simple reason, and this is the part that makes the words Greg opened with so important and wise about having an investment plan and asset allocation and sticking with it. Those divergences make it very hard to time the market. Here's what I mean. The economy is moving along at a steady, slow, upward pace, but the stock market following along, suddenly it takes off well above the pace of the economy. It's because in the short term, market prices are driven by sentiment. And unfortunately, sentiment is a characteristic of human beings, and human beings are emotional. Some are more rational than others. Some of the most brilliant, talented people in the world are also brilliantly irrational all the time. If you go back thousands of years, okay, human mental characteristics and certain things haven't changed. We have fear and we have greed. And when there's fear, we flee and we overreact. And when there's greed in talking about finances, people often get detached from economic reality. So if I drew a nice straight line up about what economic growth was doing, we would have a noodle going around it, up and down, about stock prices. I stand a better chance as someone who's been involved in various capacities in the financial market since 1986. I stand a better chance of telling you what the stock market returns are going to be over the next 30 years than I do over the next 3 weeks. Because in the long run, and this is what makes investing so powerful, in the long run, the market will rise at the rate of the growth of our gross domestic product. I described to you what that is, plus inflation. I mean, obviously, if an economy has zero growth, but we do have 2% inflation, you know all your bills are up 2%. Well, the economy is 2% bigger, albeit after you take out the effects of higher prices, we're not really growing. That's why you want to have growth plus inflation. And then, of course, as you're probably aware of, stocks pay dividends. So if I add those three things together over the last 100 years, that's exactly what the stock market has done. But over a short period of time, the GDP could be up 3% and inflation 2% and the dividends 2%. That means, from what I just told you, we should have 7% return. Well, no, the stock market was up 30% last year. So because of those emotions and sentiments and outlook, it's hard to predict short-term fluctuations in the market. Now, what makes the current situation unique, before we talk about investment fundamentals, is like I described my little metaphor that we were running and we didn't see the cliff and just fell off of it. But unlike the recessions I just described to you about too much inventories or interest rates going high and choking off our GDP, this is a forced closing of business for the obvious reasons. One can debate the politics of what the right plan is. Did they do a bad job? Are they doing a good job? All of those things are our reality. That's what we have to deal with. But that is what is unprecedented about this situation. We've never, whether it's the Great Depression or the financial crisis 11 years ago, we've never turned off the largest economy in the world, and effectively we've done that. Now, in light of that, there's all sorts of theories and educated guesses about how that will play out over the next few months. The original notion that when the decision is made to turn it back on after we have some degree of control on this virus, because the economy was good, we had historically low unemployment rates, we had a great non-farm jobless rate for the January month, okay? Terrific numbers. But when you do this much damage, despite what the government's doing to plug that hole with a stimulus package and trying to keep people from losing their jobs and helping small businesses to keep people on and so on, some businesses will just turn back on depending on the nature of the business. But others are going to take time. So regardless of how high our unemployment rate goes and how low our GDP goes, if the return to activity goes well, it's still going to take months for a healing process. Now, someday further down the road, and this is for a different call and then a deeper economic analysis, we're going to have to figure out all of these things the central banks around the world, like our Federal Reserve and the European Central Bank, and our governments have done as far as spending taxpayer dollars, okay? There will be a ramification at some point. It's not for today. There's logic in what we're doing, no matter what one's political views are, whether governments should or shouldn't get involved in economies and bailouts and all those sorts of things. The primary responsibility of government in most people's mind is to protect the citizens. And so this is a unique situation, which makes it all the more challenging to look at the analysis 3, 6, and 9 months out. Now, before I go a little deeper into this current situation, I did mention I want to talk about investing fundamentals. All of this obvious volatility we see in the stock market the last few months, and we see, not to this degree, of course, but we see zigs and zags on an annual basis. We see 5, 7% corrections every year. We see 10% drops usually every 12 to 15 months, if not more often. We see 20% bear markets probably every 3, 3.5, 4 years. And like Greg mentioned, the stock market went down much more than this in the financial crisis 11 years ago. From 2007 to 2009, it dropped 58%. The playbook from an investor, before they worry about bear markets and bull markets and the time, is it a good time, is it a bad time, is number one, to have a plan. Whether you have $10,000 or $10 million, okay, you make a plan with your financial advisor. What are our family's needs? What is our income? What are our expenses? What are our debts? Around that plan, then, we look at your savings, whether it's a 401k at your company or money you might have at Empire with Daniel. All of those things we look at and we determine what is the portfolio that job one over the investment time frame we have. If we're talking to a 40-year-old couple, their goals might be college funding and retirement. So that's a long-term portfolio. But in addition to creating the asset classes, and there's more asset classes than just stocks and bonds that we make use of, but we piece those asset classes together to help, and this is essential, to help mitigate the portfolio volatility. Now, I said mitigate, I did not say eliminate. You cannot eliminate the volatility. You can shrink it. There's a cost for shrinking it. We have to piece in together like a giant jigsaw puzzle. We have to piece together multiple asset classes. But lower volatile assets than stocks in the long run are going to have a lower return than stocks. There can be a period of time where stocks are doing mediocre and one of these lower volatility asset classes might do better. But over the full cycle, the up, the down, and the back up, that jigsaw puzzle is going to smooth the ride. And the goal is to help prevent it from doing that human behavior I discussed earlier. That behavior of, I was all in stocks, I worked 20 years to save this money, and now it's 30% lower. Okay, well, if we had 6, 7, 8 different asset classes, it would be down, but it wouldn't be 30% lower. And now, in the same token, I mentioned, I'm talking about the fear part of us humans. Well, there's the greed part. When the market's been going straight up the last couple years, and Daniel and I meet a client who says, yeah, I need to get a certain return, I need this, but I can't take too much volatility. So you put them half in stocks, and they say, well, the stock market's up 10%, why are we up 6? Well, talk it through, sir. You've answered your own question, okay? And it's human nature, but there is no way to get full stock market returns on the whole portfolio, but only get half the stock market losses on the downside. Now, so I talked about a plan. I'm going to use a word that is as important for me as the investment officer and the fellow who constructs portfolios, but it's also important for the fellow in Daniel's seat as well as the investing family. Discipline, and then after that, a little more discipline, and then to make sure it's good, even more discipline. And I don't mean to sound like a stern parent, but sticking to your discipline can be very challenging to do because you have this beautifully constructed 6, 7, 8 different asset class portfolio, and you're at your favorite restaurant or you're visiting your friends and your friend is talking and he's saying, oh, I do it myself and I've made so much money. I have Facebook and I have Google and I have Apple and I have Amazon. Okay. But in 3 months in the fall to September to December of 2018, a portfolio like that lost twice as much as the market. It's not diversified is my point. Nothing wrong with those stocks. Some of those stocks are in some of our strategies, but within reason, within discipline, not 10% of someone's net worth, discipline. Another word, I'll only say this one once though, I don't want to be too overbearing, patience. Investing rewards patience. Famous investor Warren Buffett uses a softball metaphor. He likes to play softball at his shareholder meetings. And he says, I wait for the fat pitch, the soft pitch right down the middle. So he has patience and doesn't chase something and pay. Here, I'll use an example. We'll use a car. Everyone knows what a Honda Accord is, about the cost of a Honda Accord. A nice Honda Accord's $30,000. Well, you're all intelligent people. Would any of you pay $60,000 for a Honda Accord? It's still a lovely car. It's not worth $60,000. Well, that's when people lose patience and their fear of missing out good opportunities because, oh, that stock has done so beautifully. Any of the ladies on the call are familiar with a wonderful company that's done exceptionally well as a company. Difference between a company and a stock. Ulta Salons. They're having a tough month now because no one can go, but that aside, Ulta Salons is a great company, but one year the stock went up 300% and their earnings didn't justify it. The company was just as good a company 6 months later, but it was down 65% while the market was going up. That's an example of investors falling in love with an idea, but not paying attention to what they were paying. They paid $60,000 for a Honda Accord. All right? We do our best to never do that. Okay. Now, we've talked about a little economics and market relationship. We've talked about some foundational ways to deal with constructing portfolios, investment fundamentals. Now we're going to talk about the current situation, and I've already touched on a few of the important points. As we mentioned, the usual recessions caused by imbalances, this one is a mandated recession. And outside the obvious humanitarian issues, which are the most important to all of us as citizens of this country and the world, from an economic standpoint, logically, and this is an assumption, making the assumption that our talented medical community, I'm talking like the biotech pharma company research now, not talking about the caregivers and doctors and nurses who are working so hard with underwhelming amount of equipment, okay? If we're able by early summer to get a therapeutic, it's pretty much determined, unless something miraculous happened, that a vaccine would be an early 2021 event at best hope, okay? But a therapeutic that could help mitigate symptoms and the degree of the illness. So I might get sick, but if I got sick this summer and there was a therapeutic, I might not spiral to the point where I needed to be hospitalized. And a statistical misnomer that a lot of people are making, fewer and fewer are making it as this has gotten worse, but it was the sort of January, February narrative. Well, X number of people get the flu and this many people die every year. Why are we freaking out? Well, okay, let's think about that. You know, whatever the number is, 20,000 died one year, 50,000 another year, and just the regular flu. But we have multiple therapeutics for the flu, and we have a vaccine for the flu. So if you take something that is only as easily transmittable as the regular flu, and the evidence is that this is easier to transmit, and it lasts longer on surfaces, and you don't have those two things to mitigate it, well then logically, you're going to get more people sick, and a lot larger number die. And so that in a nutshell, while you could get a medical expert on to talk far more eloquently than me, that in a nutshell is why this is such an overwhelming problem. So if we get a therapeutic by summer, that would likely mean, if we've bent that curve and the number of cases aren't growing as fast anymore, and we start to reopen the economy, because the government and the central banks have sort of created a bridge. It's not perfect. It's not going to cover every single wound that was done by the shutdown of the economy. But if we get over that bridge and people are returning to work, hopefully late April, early May, but that's all conjecture. It is logical to assume the third quarter, meaning July, August, September, will be, for lack of a better description, a time of healing for our gross domestic product. Whether it's the second quarter, the one we're about to enter, April, May, June, is going to be a historically bad negative figure. Okay? Bigger than anything we've seen since the Great Depression. But the difference should be that it's a quarter and a half, as opposed to a decade of ups and downs where we had 20% unemployment, got back down to 12, went back up over 20, the stock market was all over the place, blah, blah, blah. It was not a pretty decade, all right? Under the assumption that we're able to heal the economy over the summer, the fourth quarter of the year should, and most economists are predicting at large range of predictions, should by the fourth quarter, we should see significant snapback of growth. Now we're going to tie in actual history. All of those different financial corrections, recessions, disasters Greg talked about. Black Monday, 1929, the Great Depression, World War II, Korean War, Cuban Missile Crisis, the 73-74, nicknamed the Nifty 50 crash, 50% in the Dow Jones. All right, the brutal recession with 19% interest rates, 80, 81, 82, the 1987 crash, the 1998 Russian crisis where the big U.S. hedge fund blew up, the dot-com bubble, and then, of course, the great financial crisis. What is the, now I'm going strictly, not economics here, just stock markets. There's one unifying principle that happened in every one of them. Stock markets bottomed out before the economy got better. I say it again. Stock markets, the wisdom of the crowd, do a pretty good job of seeing 6 months forward. Therefore, if I was typing this for you to read, the if would be in capital letters because we don't know this, but if the fourth quarter is going to be a good quarter and America, as well as all of our allies and countries around the globe, economies are healing to varying degrees, I would expect stocks to really start doing pretty well, definitely by May. Now, we've had 2 really good days in a row here. Some people are saying, is the bottom in? Is the bottom in? I don't know. My prediction is we're going to go up and down a lot for the next 6 weeks. Could that mean we get a little lower than the low point we had on Monday? Maybe. Could that mean that is the low, but we're going to bounce around here? Yes, all of these things, which is why if someone gave me $1 to invest tomorrow, I wouldn't put the dollar in all at once in markets that are this crazy. Okay? I would spoon it in and I would have a plan. Just like if you have a 401k, every 2 weeks they take some money out of your paycheck, and at high prices, at low prices, you're spooning it into the market. And you're taking advantage. You don't stop spooning it in when things get ugly, because you're getting more shares with lower prices. If you put $1,000 in every paycheck, it's buying more shares than it did a month ago. Okay. Before I'm going to conclude, but I want to add one last thing about the market's so-called, the way I described it, the brilliance of the market predicting the future. it's brilliant, but it's not infallible. There's an old economist joke where a lot of times if the market's early, you start selling off. The market drops quick, like the fourth quarter of 2018 when we dropped 19%. And everyone was saying, recession's coming in 2019. Well, it's in lab terminology, it was a false positive. Okay? Sometimes the market makes a prediction that doesn't turn out to be true. Well, guess what the market does? It rebounds. Okay? So, to conclude, fear is understandable, but it's such a powerful human behavior, it is not the friend of an investor. That's why our approach at Empire, we make the consultative approach we have with our clients even more powerful than any one person. Here's what I mean by that. If one of you chose to work with Daniel as your financial advisor, Daniel in turn works with a portfolio strategist, that's me, and a financial planner, a fellow named Mike. All right, and each of us have different areas of expertise, and together we believe we do a better job than not all financial advisors out there, but because of our different areas of expertise and experience, we're kind of covering all the bases and giving you a firmer foundation than a one-legged stool versus a three-legged stool. And we consult amongst ourselves, and of course, we're all available to consult with the clients through Daniel as the point person. And I can't speak enough about the advisor-client relationship, because the most important thing a person can look for in a financial advisor, yes, you want the man or woman to be intelligent, of course. You want them to have experience, of course. But the most important thing is building a trusting relationship with them. And that doesn't happen on one phone call, and it doesn't happen in one meeting. That happens over time. But like many parts of our society, there's many good people in an industry, and there's some not so great people. And finding someone that the markets are going to do what they're going to do, we can't change that. But we can, with transparency and integrity, show you how we approach being stewards of your wealth. Folks, these are really fascinating times, and I'm looking forward to reading about it in 10 years. Living through the markets the last few weeks, the amount of hours on the phone with some of our great clients, it's been both challenging as well as exciting, and I do believe this presents an opportunity for someone who hasn't been invested to begin the process, to not get overly aggressive. You will rarely have a chance to invest in more volatile markets than what we've seen. Most of investing is the patience I talked about earlier. But every once in a while, your discipline and that patience will be tried with events like this. So I'd like to end my talk there and open it up for any questions.
Yeah. Can I be heard right now?
I can hear you.
Yeah. Okay, great.
Everybody
so if anybody,
can hear you.
Yeah. Tony, thank you so much
Mm-hmm.
for such a comprehensive lecture. If anybody has a question, please feel free to ask a question. If you don't have any question right now, but you know, right as soon as you get off the call, you may have a question. I believe you should see the information on the screen, my information. Please feel free to email me, call me. I will get back to you. If I don't answer immediately, I usually get back very quickly. So if anybody has questions right now, please, it's our pleasure to answer them.
If you'd like, you could type the question or you could unmute and
Sure.
ask the question. Feel free.
I guess Tony was so clear that no one has the questions anymore.
Yeah, I had a
Okay,
question. Does anyone hear me?
Oh, good.
Yeah.
I can hear you.
All right.
I have a question.
So it seems since the month is ending and I haven't maxed out my Roth, so would you suggest somebody dump their whole, let's say their whole contribution in the next 30 days? Does the question make
Yeah,
sense?
what I would do, not knowing your particular situation and how much other money is in the Roth, but I would make the contribution and then set that this year's contribution to maybe putting a little in, break it down, because you're probably going into a mutual fund or something like that.
Yeah.
You could potentially like put a little in every 2 weeks, that kind of thing.
Mm-hmm. Okay.
Okay, that way you're not lumping it all in at once. It's just a way to ultimately, you're going to take advantage of some weekdays, and you might pay up on a couple strong days, but yeah. So there you go.
Right. Okay. And another question. So, a lot of people are very into. For the past few years, I've been mostly doing ETFs and easy things I don't have to think about. Now that there's so many discounted stocks, would you suggest for someone to just use Robinhood or whatever's out there and just try to pick out those discounted stocks? For example, simple ones like Starbucks and Disney.
Sure.
Yeah, I personally feel those two specifically are maybe not today, but in general over the last week have been at a discount.
The answer is, first off, without knowing someone's particular financial situation, what their savings are, what their income is, what their debts are, these are only general, answers. But that said, if one is disciplined about what % of their savings they're putting into volatile equity markets, then certainly buying name brand blue chip stocks when they're 20, 25, 30, 35 cheaper than they were, unless something's drastically changed in a company's business. I'll give you a good example. You mentioned Starbucks, you mentioned Disney. There doesn't really seem to be a huge fundamental change in what their business is going to be like the next 5 years. They're just getting hurt with an effective fourth shutdown of the economy. However, a company like GE, and this is more for a couple of years ago when it was $30 a share, and they got caught with way too much debt and leverage in a couple of their business. They had so many different, they were a conglomerate. They had so many different business lines. Some of them were hemorrhaging money. And so the stock went from 30 down to 5 or 6, back to 13, down to 6, whatever. Something had fundamentally changed at General Electric, a famous American company. So if you're doing the stocks yourself and not working with an advisor who can get research from a company, then you need to do a little homework on your own to look at what's going on. And you can find so much on the internet that we couldn't do when I was, coming out of college and that sort of thing. But if nothing's fundamentally changed, it's usually a reasonable strategy to buy what they nickname blue chip companies after they become discounted. But again, you have to don't look at them as trades, look at them as investments. Look at them of what % of my assets are in equity. I don't recommend anyone, not the little beginning investor or Mr. Jeff Bezos. No one should be all equity, although he could if he wanted to be.
Tony?
I'm seeing a whole bunch of comments. Yes, Greg?
One thing I'd like to add to your comment, on Tony's comment, the specific question was about Starbucks. That when you're looking at these specific companies, as Tony describes, make sure that the depreciation in the specific issuer that you're looking at is direct related to the market dislocation. So Starbucks and Disney were clearly related to the dislocation of the COVID-19. But if you look at a company again like Boeing, which went from $300 to $90, they had several underlying issues. It was oil prices, it was COVID-19, it was the fact that they're trying to get their 737 MAX back on flight and they're overwhelmed with debt. AT&T, another company that although that went down in the dislocation, they have a numerous amount, $200 billion in debt, and credit markets are frozen, so it's bigger than COVID-19. So to Tony's point, when you're looking at these companies like Disney or Starbucks, which Disney, 40% of their business is from the park, so it's understandably that they're down. Just make sure that you're just not lumping it in and saying it's down because it's COVID-19. As Tony indicates, make sure that you've done your work and there's no other underlying issues that are also causing it to go down that you miss.
Got it. Thank you.
You're welcome.
I'm reading in the group chat. I got a couple private messages, so I won't say the person's name, just what the general question is. Someone wrote, if someone said they had 100K to invest, should they invest the whole amount or only part of it? This is the same kind of answer as we've given a few times, okay? Is $100,000 all the savings they have, or is it a new $100,000 on top of $500,000 they already have in savings into some form? So, assuming it's a brand new $100,000, I would say, okay, it's $100,000 cash, so it hasn't gotten whacked the last month. All right, how old are they? Do they have debt? How many children? What are their goals, etc.? And then I would make an asset allocation. Okay, the asset allocation would be different if that person's 80 versus 35. If that person has no children or 4 children. All of those things would come into play, but what the general suggestion would be is to create a multi-asset portfolio. Stocks, not just US stocks, global stocks. Bonds, some global bonds. Commodities, gold. What I call alternative investments, which I'm not going to get into tonight, but real estate investment trusts. The more assets you stick in there like a jigsaw puzzle, the better the portfolio actually does over the long run. Because ultimately, the goal of a good portfolio structure, Daniel's going to shake his head because he's heard me say this 10,000 times. But if Greg and I were 2 different competing portfolio managers, and that person with $100,000 asked for a proposal from both of us, and we each determined with our planner that that person, to reach their goals, needed to average a 7% return. So we create a portfolio with a 7% expected return. That's neither here nor there how we do it, but okay. But Greg's portfolio has a volatility, in statistics, that's variance, okay, a volatility of 10%, and mine has a volatility of only 9%. Mine's less volatile. Well, my portfolio is better because it's not going to be that huge a difference, but I'm 10% less volatile, which means when we do poorly, we don't have to do as well to get back to where we are. So I can raise my volatility from 9 to 10, but then I've increased my expected return up to 7.7. So you're going to choose the better structured portfolio. That's the backdoor answer to what you do with the new 100K. You build a portfolio. You don't just say, I have hardly any money in stocks, but we've had a big sell-off, and I'm going to put 50 of my 100 into Amazon because everyone's staying home and needs deliveries, and I love Starbucks. I'm going to put 20 in before you know, you have a 5-stock portfolio. And you may do great for 3 months, or you may do horribly. It's too random. It's not investing, it's speculating. Any other questions?
Antony, I would like to ask another question. Can you hear me?
Sure. Yeah.
There was a question here in the chat about the VC's investments. So they're also on discounts. Many venture capital opportunities are on the discount. So how do you estimate that against the high risk assets? And should they be in your portfolio or not?
Well, venture capital as a wide-ranging asset class, it could have some issues going forward because companies at a venture stage often need more influxes of capital along the way. And it's really hard to raise new money now for that sort of thing. Okay? It's hard to raise new money for illiquid investments. In other words, if you started a company and I'm one of the early investors, all right, I just can't get my money back because I happen to need it because something came up. Like I could go sell my shares of IBM first thing tomorrow morning if I needed money. And so when things become dislocated like this, capital flows often dry up. And I think that's part, I don't know if you're following, but SoftBank, that major Japanese venture capital private equity type firm, while I think they'll come out, they're so big, they're going to come out at the other end okay, they got to raise some capital for their organization. They're going to sell 41 billion of their assets. Now they have a $125 billion stake in Alibaba, which was a home run investment for them, no doubt about it. But nevertheless, they're probably going to sell 15, 20 million of their Alibaba stake and then a bunch of things we probably haven't heard of. So I think if you're already in venture, hopefully it is with, well, there's two ways to be in venture. You could be doing single one-offs, like you're investing in my company or Greg's company, okay? Or you could be investing through an outstanding venture capital fund like Kleiner Perkins or Blackstone or whatever. And, you know, those are people who know how to navigate these choppy waters. But nevertheless, there could be some challenges over the next 6 to 9 months in venture capital. Now, new venture capital funds that are getting kicked off now, so they're not up against it on their existing portfolio companies, they can come and pick through the carnage. Because what happened in 2008, companies that weren't overinvested in venture, like big hedge funds, were able to buy portfolio companies from companies that were in trouble, or like some large college endowments that were in trouble. Columbia University had to sell some of their venture stakes. Fortress hedge funds were buying them at 40 cents on the dollar. They did quite well, but that's because Fortress had capital. You don't have capital, or you're too much over, you know, out leaning too far into the wind, you could be in trouble. So I think the next 6 to 9 months are going to be problematic for venture. If you're invested, you want to talk to either your manager or the specific companies to see how they're navigating basically a shutdown of their business if they have the capital to make it to the other side. Because make no mistake, venture companies are not getting any of this stimulus package. Okay, not happening.
Thank you. I appreciate your answer.
Sure. Any other questions? Someone in the chat asked me about thoughts, the results of the proposed government stimulus package. Well, like I alluded to only for a few seconds, regardless of one's thoughts on, you know, whether they're a libertarian or ultra progressive and you want big government, small government, again, I think everyone views that the government's primary responsibility is to protect its citizens. Now, you can have trouble with a bailout for a company that had malfeasance or wasn't run properly or had too much leverage and got themselves as well as their employees and their community and their country in trouble. It's a different situation than companies doing the right thing, from an airline to a diner that you might go to in your neighborhood, and the government's effectively shut them down. And so as a don't get government too big kind of person personally, I believe this is the kind of environment where a government does stand in, especially because they're the ones mandating the shutdown. Now, I know a lot of this will be loans, but a lot of this will be money the government never gets back. But what the government might be preventing, number one, is an extreme loss of life. And number two, by giving small businesses a bridge to a few months from now, they're going to mitigate, even though it's going to be bad, they're going to mitigate unemployment. They're going to mitigate the number of businesses that can't reopen. And when you put all that together, we actually will have a stronger economy on the other side of that bridge. So do I think they're going to make the perfect plan and it's going to address everything equitably and all that? No, of course not. It's bureaucratic and a government. Not. But the effort is, look, it's got to be a real bad issue in our current state of politics for these two parties to get together and do something this large. You know it's real. It's time. Anything else, or should we wrap it up? And I encourage everyone on the call to reach out to Daniel, whether by call or email, and he'll be happy to pass along any further questions. We could do another call at a later date, or if you're interested in working with Daniel, we could do another call.
Anthony.
Yep. Yes,
Yeah.
Yes, sir.
Yeah, Anthony, thank you for your lecture. First of all, it was amazing, and I very appreciate it that you support me and my organization. I have a question. Most of my auditory is guys who working in Russia, in Eastern Europe countries, and I have a question. How is rules and how it works if somebody wants to invest their money in stock now from different countries, not from USA?
Okay.
What is the regulations? Could you say about this?
Well, basically, when someone from a foreign country wants to have an account, a U.S.-based account with us, there's just rules and regulations as far as compliance. And to tell you the truth, I'm going to let Greg handle that question because he's a little, I mean, I know the general ones, but he would know, and it would depend on the country. Sometimes there just has to be some checks to figure out if it can go, but it's certain countries it is possible. Greg?
Right. So your question was investors in Russia wanting to invest in United States markets. Is that correct?
Yes, it's correct. Correct.
Okay. So there's actually there's a limited number of brokerage firms that will invest for Russian citizens because of U.S. anti-money laundering rules. One of them that will take Russian accounts are Interactive Brokers. They can actually open account at Interactive Brokers, and they will do business. Last time I monitored that, which was about 6 months ago, with Russian accounts. They can do business online. It's very similar to a Fidelity or a Charles Schwab, but there are limited choices there because the U.S. Patriot Act makes it difficult for firms to do business with Russian citizens, but Interactive Brokers can do it.
Greg, he also mentioned some of his colleagues and friends were in other Eastern European countries, so it would differ. Like I would imagine Poland might be easier.
Sure.
That kind of. So it would depend on the country.
It is right. So we have a list that's pretty standardized on who we can do business with. It's really set by the Treasury Department and the Office of Foreign Asset Control. Daniel could provide that list to anyone that has a question. If it's something that we couldn't do, we would be happy to refer that person or customer to someone that will do the business, right? Because we certainly want everyone investing and we want to build financial literacy. So if you contact Daniel, we can provide a list of where we can do business, and if there's some deficiency that we can't do it, we're happy to provide you who can. Did that answer your question?
Yeah, thank you very much for your question. Answer.
You're welcome.
Anthony, we have more questions. We have a question. What do you think about the gold and oil in the short upcoming term? And what about the energy sector?
Well, that's an interesting question, and it's actually, because of COVID-19, been kind of underreported, except for people really focused on the financial networks. When Mr. Putin and the Saudis could not come to agreement on the cuts, and then the Saudis came back just a few days later at them, I think that was a real game changer in a sector. Now, going back to the United States, the energy sector that was already pretty beaten up. Even last year, when the price of oil was as high as 60, but most of the year in the 50s, United States oil stocks of various kinds, not just the big fellas like Exxon and Chevron, but your Schlumbergers, your Halliburtons, your refiners like Valero and so on, they were kind of struggling to varying degrees, stuck in the mud, not doing well when the market was going up. And that event, in the midst of everything else going on, really broke their backs. You've seen the MLP space, Master Limited Partnerships, from top to bottom, from December through the low about 4 trading days ago, drop almost 60%. You saw Exxon go from 70 to 32. I mean, just staggering numbers. There is an enormous supply of oil. And in a slowing economy, there's less demand. You do not need to be an economist to know if you have excess supply and dropping demand, prices are going to go down. Will it be this way forever? No. There's a narrative going around that a big part of the oil problem, even before the Russia-Saudi head bumping, was that ESG, environmental and social governance investing, turning away from fossil fuels, less money was going into the sector. That is true, but it's an exaggerated truth. Regardless of what one believes about the efficacy of alternative energy sources, we're probably 3 decades away from being done with fossil fuels. All right? It's just, and by the way, the lower the prices are, the longer it's going to be. I mean, if oil was at $300 a barrel, you'd be darn well sure people would be buying electric cars, okay? But at $25 or $30 a barrel. So what do I think of it as a sector? I think there's going to be bankruptcies amongst the smaller companies. I do think Mr. Putin certainly would not mind if he helped cause some bankruptcies in the Permian Basin, because that's where a big part of our supply and the fracking area comes. That's really helped us become more energy independent and less reliant on the Middle East and other countries. But nevertheless, I don't know who can wait each other out longer on this battle, the Saudis or the Russians, because it's a big part of the Russian economy, and it's a real big part of the Saudi economy. And both, the United States doesn't need $70, $80 oil. It just needs 45 or 50. Okay, the Saudis and the Russians would really love $75 or $80 a barrel. They're not going to get it if there's not cooperation between them. All right, but there's also a lot of geopolitical crosswinds going on. Now, from that does come opportunity, but one would need to be extremely selective in the energy space, because there's going to be some winners. I mean, if we got 3 decades of fossil fuels, there's going to be winners. There's going to be a lot of losers. And this isn't talking about some other sector like, oh, well, it's underperformed. There's going to be bankruptcies in the U.S. energy space. There's no doubt about it. They might be companies you never heard of, but there's going to be bankruptcies. Okay.
People are asking, what about gold?
Gold is in my multi-asset strategy. Gold is something I almost always have. It's just a question of how much. Okay. Gold helps. It's one of those things that's low correlation to what stocks and bonds are doing. So it can have a tendency to be a helpful piece of a portfolio. That said, it's just a chunk of metal that pays no dividend. And because of that, I wouldn't get overly invested in it. But I almost always have some on. In this environment with low interest rate world, the fear of deflation, it is very logical to have some gold. So whether it's 3% or 5%, it's a piece of my multi-asset portfolio.
Can you comment this question? REITs are down now about 50% or more, and they are usually give the biggest dividends, 12% plus. Is it good time to invest now?
I really like REITs as a general sector, but without talking about the specific company, when he says 12% yield, he could very well be talking about mortgage REITs, okay? Not your typical REIT. There's a lot of technical dislocations going on in the market, which was what the Fed was trying to work on, an incredible domino effect because of the trouble commercial real estate is having with this crisis. Might there be an opportunity in mortgage REITs? Sure, but selective. Again, I wouldn't just buy some mortgage REIT index. Invesco, there's some mortgage REITs that the underlying product uses leverage, and then there's an ETF that is using leverage on the positions with leverage. Think about that. It lost 82% last month. Okay? So you have to know what you're buying. I like REITs here. I think they're more undervalued than stocks, but the REIT position I use, the manager I use, through I think Tuesday, it was down 25% year to date, but the index is down 35. Okay, last year he was up 40 when the index was up 30. He's very selective in this space. Okay, that's what you have to be. Don't just go buying yield. Uber high yields often mean there's a problem or there's leverage. Okay?
Thank you so much, Anthony. Thank you for your answers. We have more questions. Do you have time?
I tell you what, why don't we do 5 minutes,
Okay.
and then I'll take my dog out.
Okay, so the
He's up
following
late
question,
tonight.
yeah. How would you project the real estate market to affect, and for how long it would be affected?
Like residential real estate, apartment buildings, that kind of thing?
Yeah, let's talk about it.
Okay. Well, not to sound like a silly real estate agent, but location matters, obviously. And what I would think would happen is once the economy, I mean, I think a lot of people aren't going to go out and look at houses. They were planning to go to an open house Sunday. There's no open house anymore. Okay, or they were looking for income buildings, but now they're worried about, well, could I fill all the apartments if I bought that building? So what it's going to do is just cause a freeze in action. However, when the cloud lifts, and it will lift later on this year, we just don't know when, and people have their jobs back, and it's safer to go about our business. Interest rates are really, really low, so I would expect activity both in the single-family housing or an apartment building to pick back up in regions where the jobs are strong.
Okay, it's time for a good example. So the example is like that. If I have 500K to invest, what amount I invest per day, 5% will last 20 days. Is that too long or no? We should do 3% per day since we are at bottom or almost there.
Well, you know what? It's an identical answer to my $100,000 example, because if this particular family has $5 million but a new 500 grand, it's a different answer than if this 500 grand is everything. Is this particular family 70 or 30? So, and I don't need those answers. What my point is that what makes the most sense is to work, unless they have great experience as an investor themselves, to literally take the time to work with an advisor to make a plan. And by the way, if they have zero invested, while the plan will ultimately determine the full asset allocation, if the advisor and the person said, but what if the market, all right, well, we're going to put 50,000, we're going to put 10% of it in while we're working on the plan. And the market drops a little more and you put 50,000 more in. And when I say in, I don't necessarily mean all stocks. Maybe it's some stocks and bonds and some REITs. Maybe it's some stocks and bonds and some gold. And you just do slices of it. And before you know it, after a few months, you got some great low prices, you got some good prices, and you got some when it was really taking off. All in all, you got a nice looking portfolio with a plan. Okay, because if you have no plan and you put the 500 grand to work and the market goes a lot lower and now it's worth 420, what are you going to do? You don't have a plan. You're in a lifeboat with no life jackets and no paddles. You're just floating. You get yourself into trouble that way, and then you make a bad decision to sell when it's low, and you locked in that 80 grand loss in my example. So a little time investing on the front end with an advisor is really the way to go.
Thank you so much. It was very good. It was very informative.
Thank you.
Yeah. Let me just, if I just may say two more words. First of all, thank you, Anthony. Thank you so much, Greg. Thank you very much. Faina, Ivan, thank you so much for organizing this. Thank you so much for all the participants. If you have any questions again, please feel free to reach out. We'll be happy to give you time and fulfill your needs. Looking forward to speaking to all of you.
Good night, everyone. Thank you, Faina. Thank you.
Good night.
Thank you.
Good night.
Thank you. Thank you. Thank
Goodbye.
you.
Thank you.
Thank you.
Bye-bye.
Thank you so much.